it's getting more and more difficult. I was sitting together with a developer yesterday who is changing his price list for his projects by the months. So it is only valid until the 30th or the 31st of each month, and then he's readjusting his pricing according to the offers he's getting, and that's kind of crazy. And we need to educate the investors into our fund to the risk return profiles. I think picking up the point that we heard before, many occupational pension funds, they always had, and insurance companies, they always had the bonds to invest in. They can't do that anymore. Insurance companies are still at 5 to 6% real estate quota. Pension funds are already up to 20 to 25% real estate quota. And we are currently, for example, in the pitch with an insurance company who, despite the best finance environment ever, are saying we want an equity-only mandate, and we are happy with returns between 3.5% and 4%. If we commit 500 million and take finance, then you guys have to invest a billion for us, and you don't find that in the marketplace. So we rather have 500 million in equity only, and we're expecting those low returns. So if the investment manager and the investors are agreeing on those points and on those low return expectations, then it's fine. But we were seeing many competitors out there in the market who are outbidding us in those sales processes that are happening, and I agree with Philip. We can't succeed as a German-based investor with those pricings, because they also need to do an exit scenario, and they always assume that they get the same multiplier or exit yield as at the entry, and that's foolish. After 5 or 10 years, you can't expect that you're in the same marketplace, and those business plans will certainly go wrong, and investors who are holding that expectations and are having underlying investors behind them, they will be fooled and they will be disappointed. So it is all about communication, that you have the same risk return profile with your investor background.